You talk a lot about the deterioration of risky assets at the end of last year. Has that changed for you now in 2019?
Well, clearly, I think, the Fed's so-called U-turn, I think, made a big difference there. I think the volatility in asset markets we saw in Q4 last year was almost entirely a misconception, I think, by the markets that the Fed was going to be inflexible if growth data continued to turn down. And I think the clearest way to see that is if you look at the price action in February, the S&P was down 9%. The 2-year Treasury was flat for the first 4 weeks. So it's hard to square how the equity market appeared to be taking growth expectations down, yet not pricing any change in the forward path for the Fed.
Well, when you talk about growth expectations, we've had this ongoing debate about an earnings recession versus an economic recession. Arguably, economic recession much harder to get to. Right. Do you expect an earnings recession this year?
No, we don't. I mean, it's a risk. Late cycle expansions typically put pressure on earnings as wage pressures start to pick up steam and competitive pressures keep a lid on pricing. We've been expecting to see some of that margin erosion. We've seen a little bit. We've plateaued, years back. But having said that, there's been a surprising resilience of pricing power, I think, in the corporate sector. So it wouldn't be our modal view that, the margins are going to, fall over an edge and precipitate an earnings recession, as you call it.
Another one of your bolder calls has been the 10-year yield is nearing its peak. What does that mean for you in terms of the sectors that you do like, in terms of the rotation, again, maybe sort of into some of the riskier assets?
Well, I'd say a couple things. I mean, the fact that it's at a peak here is really symptomatic of the fact that we think the Fed is done or close to done. It's hard to judge whether we're going to get another hike here or not. It's possible. But for all intents and purposes, we're done. And I think that's been a huge, break for markets, which I think, as I said, risk appetite always suffers when the Fed is hiking and when rates are rising. And so so taking a break from rate hikes is obviously going to breathe a lot of wind into risk appetite. The question then is, where does risk appetite go in 2019? Does it go to growth assets or does it go more to carry assets? And our view is that growth assets are challenged, right? I mean, our economics team thinks that U.S. growth will be decelerating in 2019, and so that's a hard market to love for equities. But I think for credit spreads, which are only at their 40th percentile versus history, which is actually pretty generous spread, or whether it's various forms of being short vol, I think that carry type trades, emerging markets, maybe most of all, I think those carry trades have a little 3 to 6 month window here where they can do quite well, because I think it's hard to imagine that the Fed will deviate significantly from the course they've just reset for themselves.
And when we talk about the Fed, it's very interesting. In your note, you say that the Fed has actually hiked more than we think, and one way you're measuring that is by looking at the shadow rate. Is the Fed then sort of on the curve or ahead of the curve versus other people who might say that maybe they're a little bit behind the curve?
I think it's hard to say they're behind the curve. I think they're in about the right place, to be honest. I mean, I've made that point that, if you start from a shadow rate of minus 3% and then look at the 250 basis points since then, 550 basis points of removal of monetary accommodation, it's actually a pretty meaningful hiking cycle. That would exceed the last 3 hiking cycles. I'm not claiming that's necessarily the right metric, but it just kind of helps to reframe, I think, why risk assets were having a hard time last year, first in EM and then in DM, why they were having a hard time absorbing the expectation that the Fed was going to be, on this hiking trajectory. I think since the start of the year, we're in a much better place. They've signaled pretty convincingly, I think, that they're, going to be patient and that they can afford to wait and see. Because, we're not seeing the kind of inflation that you would normally see at this phase of past expansions. And that's the thing that really is different this time, is that, as we've said in a past report, there's no motive for murder on the part of the Fed this year.
So what does that mean for credit? We've talked a lot about BBBs making up a big portion of the investment grade index. Some bond deals now come a little bit more covenant light. What's your view on the BBB and then maybe the high yield sector? Yeah,
well, I mean, the concern there, and this is a common concern in the market right now, is that the BBB sector has grown, very dramatically over the last decade. And there are some names and some sectors there that are a little bit soft and could be vulnerable to downgrades if the economy were to turn over, or if even just those sectors had, some disruption. And so I think the concern there is that you have a big chunk of downgrades that then drop into high yield, and then that's a lot of supply for that market to absorb, and that would reprice spreads higher. I don't want to totally dismiss the scenario, but I think it's a relatively low probability, and I think it also underestimates how well markets could absorb, that big of a downgrade. Most investment grade managers have basically mandates that will allow them to hold that debt if it does get downgraded, and it's also not your father's high yield market, right? It's a pretty deep, sophisticated market. It's still vulnerable to inflows and outflows, and that would be a meaningful outflow effectively. But
does that deep and sophisticated market also translate into the leveraged loan market?
Which is the second market people like to worry about lately. Yeah, I mean, I think personally that the concerns about leveraged loans are overdone. I don't want to claim that there hasn't been some erosion of covenant protection in those documents, that there has been. And in large part, I think that reflects the evolution of the borrower base, which is, dominated now by companies that are backed by private equity sponsors. And they put a lot of value on the flexibility that they gain from an operational perspective and from a financial perspective of not having too many encumbering covenants in the debt. So I really think that what's happened is more of a 20-year trend than a late cycle, erosion of things. There's a little element of both, but I think it over-dramatizes the story to just highlight the fact that some covenants have gone away and that this is somehow, precipitating a major credit problem. I don't think that's true.
A year ago, you put out a report about liquidity being the new leverage. Quickly here, a year later, how does that look to you? How does liquidity feel?
Yeah, I mean, so that was a report where we were kind of pointing out some of the parallels between, the post-crisis liquidity environment versus the pre-crisis credit environment. And I would make a couple of comparisons. First, just like credit was characterized by dramatic financial innovation in the pre-crisis period, the provision of secondary market liquidity has been characterized by equally dramatic financial innovation in the post-crisis period. And that's basically, the evolution of high-frequency traders as the dominant supplier of liquidity in our most liquid, asset markets. And then the question is that something to worry about or not, right? And I would say the reason to ask the question and the reason we asked it was that we do see flash crashes happening on a much more frequent basis than we've seen historically, and you have to ask why. And I think a good answer to that question is that liquidity always evaporates in a downturn. But if machines are supplying it instead of humans, I think it evaporates faster. And I think that's why we have these flash crashes. And I think the risk is, of course, that these flash crashes can become self-fulfilling narratives.